This is Chapter 15, Discussion Number 3, Regulating the Money Supply. Remember that the value of money is partially dependent on how easy is it to get. And so as the Federal Reserve works to regulate the money supply to make sure that we don't have rampant inflation or we go back into the dark ages, the banks need to make sure that they are making that the amount of money that's available per person reaches a certain amount of scarcity. So there are several things that the Federal Reserve does in order to control the amount of money available. First one is the idea, remember that we have a fractional reserve banking system in the United States, which means that the total amount of money that is reserved in banks is not all the money that is actually been deposited in the bank. You see, according to federal law and Federal Reserve regulations, banks are required to keep a certain amount of money on hand. Currently, it's 10%. It's been 10% for quite some time. These reserves are to service any customer who comes into the bank and says, I want my money. And that the banks are dependent on that not everyone will show up at the same time. Now, what do they do with the other 90% of the money that's deposited? Well, the banks loan it out. And the way that this expands the money supply is that money that is taken out from one bank will be put into another bank, and then that money will have value, and then that money will be loaned out, some will be given out. And I have a table here so you can kind of see what happens. For example, let's say that I get $1,000. So I put that in my bank, and I have $1,000 anytime I want to come get it. But the bank is only required to keep $100 of that. And then they give out $900 in a loan. So I've added $900 to the economy because the $1,000 is still there, and I have another $9,000 coming out of the bank. And then I pay that to CVCS to pay for tuition or that type of thing. So the bank, the Cumberland Valley Christian School, gets $900. They put it in their bank. They keep $90 on hand in case anyone shows up, and they loan out $810 because they had to pay for a new copier. So you see that we've added another $810 to the economy that didn't really exist, but because the banks work on a fractional system, they keep a little bit of the money and loan the rest out. Then they pay to the copier company, then they put in their bank, and then we have the fractional reserve system hit again, and then the circuit boards. And so this is a multiple expansion of the money supply as it continues to go through. Again, think back to the George Washington, where's George Washington example of the dollar bill, where you could put in the serial number and see where all it's been. The same thing's happening when it comes to loans. So by changing the reserve requirement, would change the amount that banks have available to loan out to the customer. So if they would reduce the reserve requirement, that would mean more money could be loaned out by the banks. Whereas if they increase the reserve requirement, saying that banks had to keep 15 or 20% of their deposits on hand, that would reduce the amount of money available in order to loan out. So another way that the Federal Reserve can adjust what happens with the discount rate would be to play with the discount rate. The discount rate is when banks need to borrow from the Federal Reserve. And as they borrow from the Federal Reserve is going to charge them interest. But this discount rate would then affect how money is going to be charged to consumers, because if the Federal Reserve increases their discount rate, that would mean that the local banks would also increase their rate as they sell loans to consumers, and so therefore that changes the interest rate. Now, another way that the Federal Reserve can affect the money supply is affecting the federal funds rate. Federal Reserve found it necessary to control the interest as it goes between bank to bank. Banks were getting very competitive and not exactly playing well with friends, so the Federal Reserve also establishes the federal funds rate, which is where banks borrow from each other. They use a uniform number so that banks work with each other and there's no fighting over business or anything like that. It makes it a more civil business. And so the federal fund rate is, again, another way that the Federal Reserve controls the interest rate, because if those interest rates go up, then the loans that are going to be put out to consumers, their interest rates are going to go up. And if their interest rates go down, then their interest rates are going to go down. Now, another term that you might hear in dealing with loans is the idea of the prime rate. And the prime rate is pretty much the lowest rate that a bank will offer for any loan. And the only way that you're going to get this loan is if it's a loan and you are a regular customer of the bank and you do a lot of business with the bank and the bank really knows that you pay everything back and you are a best customer and the bank's going to give you a prime rate. But most times regular consumers are not going to get this. This is primarily going to business persons. So another way that the Federal Reserve also regulates the money supply is the buying and selling of government securities. See, they buy Treasury notes, bills, and bonds from the government, and then they sell them on the open market to investors. Now, Treasury notes generally are good for about 6 months. They might have interest attached to them and essentially work as cash in the investment sector. Treasury bills pretty much have interest that lasts for 2 to 6 years. And as the interest accrues, then you can sell them back to the government, and the government will give you the interest on them. And bonds are pretty much 10 to 30 years of what you can purchase from the United States government, or more particularly from the Federal Reserve. And they have interest attached to them. And after they're done maturing, when they get to their 20-year limit or their 30-year limit, then the interest rate really reduces itself, and that's when you're supposed to sell them back to the United States government. So, but the Federal Reserve buys a lot of these securities from the federal government, kind of acts as loans to the United States government. And when the Federal Reserve wants to sell these on the open market, this is a way that they can reduce the amount of money or increase the amount of money in the economy. See, when the Federal Reserve wants to decrease the amount of money in the economy, it will sell the Treasury securities. Now, as they sell it, they hand the certificate out into the economy, and then the people give the Federal Reserve cash. So that removes spendable money out of circulation. And so if the bank wants to increase the amount of money in the economy, then it will purchase the securities, and so they will take the certificate out of the economy and put cash in. And so that's one way that that's one of the big ways that the Federal Reserve controls the amount of money in the monetary money supply. This concludes discussion number 4, regulating the money supply. It also concludes the Chapter 15 discussions.